Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today, a new guest on the show, someone that I actually worked with at my first job out of college back at Moody's Investor Services almost 2 decades ago. And since then, she's been up to some fascinating things in life, attended the PhD London School of Economics program, had worked inside the Federal Reserve many years ago. So certainly some fascinating perspective, and I'd like to welcome on my dear friend, Diane Maurice. Diane, how are you doing today?
Very fine, Chris, and thank you for the opportunity. This is exciting.
Yeah, well, it's been great to catch up with you again, and fascinating to think about everything Moody's has encountered since we were there in the early 2000s, although even more fascinating to hear about some of the things you've been up to. So why don't you tell us a little bit about some of the things you've done, and then we can dig into the Fed and monetary policy and some of that good stuff.
Sure. So as we talked about, these represent my own personal views, not the views of any government or non-government entity. So we always like to make that disclosure. But I would say that if I think about my life in financial services, I think about a couple things. I think about the ability to transition and the ability to understand, or at least to try to anticipate, volatility. And I think that volatility in markets or volatility in economic trends, I think that if we think about those terms and how it maps to our careers, it allows us to sort of navigate not only the ups and downs, but in my case, it helped me stay employed for a number of years. We used to say that the average position, I'm just saying this because I've been flexible, let's just put it this way, that the average position in banking and financial services, if it was 7 years or 5 years, you were doing okay. And I think particularly in the United States, I mean, obviously the people have had a longer tenure in financial services, but in the United States, when you have mergers and acquisitions, and now with the evolution of financial technology, or fintech as we say, it's even more important to stay adept. And I think back on my career, I basically started as a budget analyst for a large state government, and then transitioned into first Standard & Poor's and then later Moody's. But in between, working at foreign-owned banks as well as North American-owned banks. And so I like to say that I've almost seen every up and down in the financial service sector that obviously affected employment. And then now in my present capacity, trying to understand economic trends in emerging markets, I think that experience has really helped me adapt, helped me grow, helped me progress as a professional, and it's been incredibly interesting. So basically, the Fed was an amazing experience, and I have a lot of respect for the Fed economists as they tried to navigate. For example, I was in the middle of the financial crisis, both as a private global banker, and then I transitioned into the Fed just to understand what was going on. And it's a remarkable job that they have to do. It's challenging. It's dynamic, and a lot of it is very much an art, because as much as we might study Hayek, for example, and the role of government, what's appropriate for intervention in the markets, we still don't know. It's still very much an exciting opportunity to try different theories, and sometimes you have to try different theories in the middle of a crisis. So being an observer and a participant has been remarkable. I think I should write another book. I've written 2 books on financial technology, which is transforming financial services as we know it. But I have to give credit to central bankers that have to make these very, very hard decisions on when to intervene, when to back off. Now that we see central banks generally, not just the Fed, sort of backing off of quantitative easing, it gives a lot of food for thought.
Yeah, it's certainly fascinating, to hear that you were witnessing part of this as it was going on, but just in general, because I guess in some senses, maybe the quantitative easing wasn't totally new because Japan was doing some form of that for a while, but certainly a lot of things that haven't been done to that extent before, certainly with the dollar being the world's reserve currency. So I'm curious, when did you join the Fed? And if you could walk us through anything you remember from when the crisis was going on, and certainly any thoughts you have on the policy that was implemented.
Sure. I mean, how I got to the Fed, in my own mind, is kind of interesting, because if I were really rational about it, there's no way I would have gone to the Fed. But I had spent 10 years studying Fed and central banking policy, including the Bank of England, that led up to the formation of the Basel Accord, which imposed or introduced minimum regulatory capital for banks globally, and in theory put everybody on a level playing field. So what happened to me was I kind of fell in love with central banking. I had the opportunity from the Bank of England to read all the papers between the Bank of England and the Fed on the decisioning around implementing minimum capital standards. And so I was kind of fascinated by this dynamic, which is sort of bridged both economic policy, politics, diplomacy, and some would say a very strong and real concern for a global economy. And so what happened to me was I found myself at one of the most prestigious investment banks in the middle of the crisis. And we could tell that government bonds weren't being traded. Pristine government bonds were just being held on people's balance sheets because they couldn't get a price, or any price, certainly not the price they wanted. And so we saw the sort of the market in the middle of the crisis start contracting, and you could almost see it. It started. I was on the money market desk. You could see it on the money market side, see it on the repo side, and all of a sudden things just sort of slowed and stopped. And then I was at this large investment bank when some investment banks failed and some were bailed out, and then I got a phone call, and I had to make a decision. Do I leave the large investment bank? It was very prestigious, to jump to the Canadians. Well, as you recall, in the financial crisis, the Canadian banks were extremely strong. Most of them had bypassed some of the highly complex structured products that other banks globally had purchased that suddenly had no market value, or no specific market value anyway.
Right.
And so I go to the Canadians, and they had money, and they had so much money to spend. And I was, from my Moody's days, and actually from my Standard & Poor's days, I was a structured finance analyst. That was my training, and as a banker too, in between. And so we went to work in the Canadian context, and they were like putting down $500 million at a pop to buy up asset-backed securities, very strong auto-backed securities, some credit cards, not so much, but very interesting, high-yield, AAA rated investments when the rest of the market wasn't doing anything, and they were trying to offload both liquid and illiquid assets they had accumulated prior to the financial crisis. And so I basically was doing extremely well financially for the first time in my life, because I was always a risk analyst. I was never really, a high running investment banker. And so I think I've always been a risk analyst, and I think that is really my forte. But anyway, I'm sitting at this Canadian bank, and I see people from my prior employer saying, "Oh, Diane, you're so smart. You jumped to the Canadians at just the right time," because the bank that I was at was almost stopped. It almost went under. It didn't eventually. But then all of my contacts and friends suddenly started going to the Federal Reserve. So I'm thinking, well, this is an opportunity for me. I walked away from the Canadian bank, and finally, after a year and a half, I hit the Federal Reserve. I call it the lottery, because at the time they put everybody's CVs into like a big a big pod, and if you met certain criteria, then you could come in and interview. And I left my job at Midtown and increased my commute by almost an hour every day. Took a huge pay cut, because I thought that if I didn't go to the Fed then, I'm not sure when I ever would have gone. And coming into the Fed sort of at the tail end of the financial crisis was fascinating, because they had just, I think, really started to emphasize the need for transparency, a lot more transparency in some of their decisioning. And I remember this one situation where we were invited to hear, internally, but it was a discussion by all of the top Federal Reserve's economists on how to intervene into the economy to prop it up, because there was some consideration that what they were doing with quantitative easing wasn't really working as fast as they would like. They didn't necessarily, they weren't able to anticipate exactly how their intervention strategies would have, would have positive or negative implications for the market. And I'm not saying that they weren't extremely intelligent, but they were. But it just goes to, back to the premise that as economists, you say it's a dismal science for a reason, but it's a very uncertain science. It's almost like an art. But just to sit back and watch these economists sort of debate some of the considerations on government intervention was fascinating, because they were really concerned that they weren't sure how things were going to play out. Obviously, the financial crisis was something that, hopefully we only see once in our lifetime. And obviously the Fed chairman had, studied what happened during the Great Depression, and they were eventually, able to implement a strategy that worked. But fast forward 10 years ahead, and now they're trying to reverse quantitative easing that not only the Fed but other central banks also implemented. We see this sort of rollback, certainly in the UK, although that's kind of clouded over by what's going to happen with Brexit. But certainly in the EU, they're pulling back. Quantitative easing has its place, but how you reverse it, again, it's probably an art too. And I mean, you have to be, I think, very, very careful. So yes, my passion as a central banker was sort of fueled by being involved at the Fed at that particular time. And I spent 5 years both in New York and San Francisco working on banking supervision issues. And you hope that you can make a difference. But, they call the large banks global, systemically important financial institutions for a reason. Can management control? Do you need government intervention? I mean, these are questions that I certainly had to think about as a banking supervisor. and now in the context of, you know, taking a step away and looking at what the Fed is doing, I also have to think about, you know, their strategies. What I'm pleased about is that, you know, there's a move towards greater transparency. I think the Fed chairman in his comments, was it yesterday, you know, basically said now he's going to move to having press conferences, I think 8 times a year, simultaneous with some of their decisioning. And I think that's a very positive sign, is to have people understand what direction the Fed may or may not be going to. So if they raise interest rates or they stop, which seems like they've stalled their interest rate increases, the fact that there's more transparency, I think, is very positive. And I think central banks around, you know, for the major countries are certainly taking a step in that direction. So the Bank of England, for example, maybe 2 weeks ago, actually had a conference on the role of central banks, whether central banks are necessary. And I think since we're on the topic of central banks, I mean, I know that you have some other questions for me, but I would say that the biggest threat to central banking and their ability to help balance the economy, whether it's interest rates or inflation, is attacks on the independence of the central bank. So it's not just the central bank independence in the United States that's under threat, but in other parts of the world, we've seen similar trends. And we have to ask ourselves, if an independent central bank, number one, enhances their role as sort of protector of the economy in some arguments. I'm not sure Hayek would agree with that, but you know, certainly there's a school of economics that would support the central bank has a strong and necessary role. So these are considerations. Today, I listened briefly to another rating agency that I didn't work at, which was Fitch. And they had 7 key themes for 2019. Global growth has peaked. Rising constraints and dilemmas for global policymakers, that would include central banks. Potential for unexpected leadership changes. Supply side inflationary pressures to mount. Monetary policy tightening and rising volatility. Trade protectionism. Increases in second round effects. And they also cite US underperformance and the potential for peak interest rates. So all of these themes, you know, suggest that there obviously is a role for some government entity, and I would argue, given my, you know, both my education and my practical experience, it has to rest in an independent body. And I think that the central banks are generally best positioned to make some of these changes, particularly in light of not only geopolitical volatility, but also, for example, climate change. So I think your program raises some interesting questions. Is there a role for government? What's that role? Is it a role assigned to an independent central bank that can hopefully make rational decisions that are apolitical? And obviously, given my background, I fall into the latter category. So I don't know. I mean, these are not easy questions. Do you raise interest rates, or as the Fed did yesterday, you wait and you see what the implications are for inflation, and then you have to balance these themes that are not going away, that are ongoing, and you know, what's the best strategy, or do we, you know, subscribe to the thought that, as I was talking about earlier, to Hayek's view that, you know, in an emergency such as a financial crisis, Hayek says emergencies have always been the pretext on which the safeguards of individual liberty have been eroded. So I'm not sure I 100% take that view. but it's certainly another perspective that we have to think about, because it really argues for the broader context that is, when do we see government intervene? What's appropriate? And I support the view that that Powell really has to be applauded for maintaining his actions, and the actions of the Federal Reserve System will benefit from additional transparency. So people understand, or hopefully understand, the direction and the implications, hopefully, of policy shifts. So he basically said in his speech that he wants people to have the opportunity to understand what the Fed's policy shifts are, and he wants notice going out so that they understand. And obviously he has a discussion of emerging risks like geopolitical risks, trade with China, weather-related disruptions, political disruptions. But at the end of the day, I thought what was fascinating is he has a big P word, P for patience, and he says that we have to be patient, and that's his strategy. So I think it's kind of an interesting shift in the context where central banks are under threat of losing some of their independence, and I'm glad that they're pushing back.
Yeah, well, fascinating dynamics taking place currently. Obviously, Trump doesn't seem happy with raising interest rates, certainly not the first elected official to feel that way. And I think what you mentioned about Hayek and the Austrian Economist, to me, is really at the heart of the issue, where it's a perspective or philosophical difference where, should we be printing money or doing lowering interest rates or quantitative easing, or should the central bank not be doing that? Again, I went to Wharton School of Business. You saw me back in my early days at Moody, so I was kind of following what I saw and heard there. And then when the financial crisis hit, I started reading the Austrian Economist, which was a much different view. But I guess what stood out to me was that a lot of them did point out some of the problems that we're building, especially, some of the later Austrian economists talked about the problems building in the real estate market following the policy with the expansionary policy after the collapse of the .com. So the problem it raises is that even in Bernanke's op-ed, when he talked about how lowering interest rates and quantitative easing was going to spur growth, to me, I would expect naturally the opposite of that when the stimulus is undone. And I think it's interesting here, we're only at 2.5% Fed funds rate, and already the Fed has been slowing down because we see the volatility in the stock market. We see the real estate market slowing down. So I'm curious your thoughts on that. Again, there's, the two different schools of thought, yet to me, I've been waiting for a decade to see how it's going to be unwound. And now it seems as if it's a real struggle to do that. So curious your thought on that whole dynamic.
Yeah, I mean, again, I've been away from the Fed for almost, 4 years now. But I mean, it's a challenge. I think that they've committed to reduce the Fed's balance sheet, and they're trying to decide what's the appropriate level. Is it 1.5 to 3 trillion? That's a number that I saw. If you increase interest rates too fast, what happens? Some people suggest that would spur a recession. So if we have the crisis era stimulus and now we're reversing it, does that impose new challenges? And some suggest that the downside risk is that stock market gains are reversed and treasury rates rise. So it's not easy. It's not like you have an on and off switch where it says, yeah, let's intervene, or no, let's not intervene. I mean, there's real costs. There's opportunity costs. There's social costs. And I just look at in my own personal life, the implications of rising interest rates on home prices. So I moved overseas. I might have a home on the East Coast. Interest rates rise. Let's say I decide to sell it. Can I? Interest rates are too high. Fortunately, job growth is robust. So that's certainly a good thing. But in light of those key global themes that I mentioned earlier, that everybody mentions, what are the implications if we place it in the broader context? And I think that one of the lessons that the financial crisis taught me is that we are interrelated. What we do obviously has implications for the rest of the world. And we can't necessarily take a view on the economy in isolation, because America's growth and opportunity is linked to global opportunities and vice versa. So I really take a broader sort of macroprudential view on the situation. And one of the issues that I found fascinating in the crisis, because I didn't necessarily personally, I had nothing to do with it, but I didn't necessarily agree, was, the trade-offs that occurred during the financial crisis. So Berkshire Hathaway owns Harley Davidson during the crisis. Berkshire Hathaway was, very astute in pumping money into certain financial institutions that eventually survived. And I don't know, since I wasn't there, I don't know if the trade-off was that Harley would be saved. And now, fast forward 10 years later, we have a trade policy that has, as far as I can, understand from what I've read, that is detrimental to Harley Davidson. And, now if you believe it, Harley's on the verge of, becoming less profitable than they were. I don't want to say they're on the verge of bankruptcy, although that's what I read the other day. But it's sort of like the upside and downside of free market theories. And if we just take that as a prototype on when the government intervenes, it saves it. On the government does something else, it pushes the company sort of to a less profitable space. And certainly, on the margin, and where in this case, maybe motorcycles from other countries, like I'm just going to throw out there Japan, since I don't have a hog and probably never will have a motorcycle. But it's just a very interesting dynamic to try to understand both, like I said, the upside and the downside of government intervention. So these are not issues that are sort of solely nationalistic, protecting American businesses. These are broader global issues that I think sometimes we just have to step back and try to understand. It's hard when you're just like in one country. So now I'm in another country and I see the same sort of dynamics. Do you protect your national industries? Do you have government intervene to do that? Or is there some balance where you let the market decide? Free trade economics would say you let the market decide. You let the least cost provider provide the best product. Well, hopefully that works. But what if the best or the least cost provider is also the least qualitative provider of a certain good or services? So then what happens? So I don't know. I don't really have any answers. That, as a student of central banking, I'm just fascinated by these very significant decisions that have to be made. And I think that the best part of the American system related to the Federal Reserve, is that they have sort of a flow of ideas, of thoughts. People working in the financial services on the private side come into the public sector for a while and then maybe move out again. Some people say that that would lead to regulatory capture, but I think that this robust flow of thoughts when it comes to something as dynamic as central banking is very important. So Chris, if you don't want to do your newscast anymore from Colorado, there could be a place for you at the Fed.
I was back in New York for visiting my mom for Christmas, and I wanted to go take one of the tours of the Federal Reserve. I'm guessing they wouldn't like my resume all that much these days. But again, it was interesting. You were mentioning with Harley Davidson and what is the role of government intervention, because certainly along the Hayekian, that's, did I just create a new term there? The Hayek school of thought, Hayekian. But basically when you get government intervention, it kind of creates a precedent where, you know, like you said, which ones do we bail out, which ones don't? And certainly with the banks, you know, when there is government insurance, I've always felt like that skews their decision making where, okay, we can take more risk. If it goes great, we win. Yet if it doesn't, we get bailed out, which has kind of contributed, similar with the FDIC insurance. You know, they are guaranteeing these deposits, then they raise the amount, but if the system runs into problems, which I see happening whenever, I mean, we're 10 years after the last crisis and still only at 2.5% rates. So I'm curious if you have any thoughts on that one, where the precedent that it creates and if it really skews how market participants are acting.
You know, that is, so obviously I believe firmly that there is a role for government, but I also equally believe, probably as strongly, that there is a responsibility for companies to manage themselves well. And by that I mean is, okay, you think about insurance, right? You think about insurance that might guarantee a crop failure. And is it the role for government to step in and help a little farmer who can't necessarily help her or himself? But then as we see more globalization of, let's just take commodities, companies that manage large tracts of commodities, and that could be wheat or corn or soy, and they have an opportunity to hedge, to go out into the market and to hedge as a mechanism to ensure, protect themselves against unprecedented price increases or decreases. It's their responsibility as managers to go out to the market and buy these commodity swaps. That, by the way, could be quoted on the Chicago Board of Trade, where there's transparency on terms of prices. I mean, obviously that doesn't work for all commodities, but you balance that against, the government role in, helping farmers preserve their independence, and then, you have to ask yourself which is the best policy, and is there room to promote sound management of hedging commodities, as well as the role of government in bailing out small farmers? Or should we just let the small farmers fail and then let all the big guys take over and let them manage it as they see fit? So there is, now that I'm working sort of on the development side of things, there's a sort of a pervasive philosophy, not only for emerging markets, but we also see it in the US. And that is, the strength and the backbone of an economy really is small and medium businesses. And to the extent that they exist and they're robust and they make a contribution to the economy in terms of job growth, that is where you want to be. And if in some cases that you need a small business administration to help spur that, is that really a bad thing? Because if we follow through on a Hayek and future, if we let the market decide, where does that leave us? Does it mean that you have these super huge companies controlling things, and then what's the price on personal liberty? So one of the things that we wrote about in our last book on financial technology is, who is regulating the other big parties that have moved into financial technology? And by that I mean, and you're surely aware of Google Pay, Apple Pay, PayPal. I mean, these are independent entities outside of the banking system, although they provide a key banking function, and they're unregulated. And then we have a situation that you read about with respect to, and I can't really follow it too closely, but what's going on with Facebook and, the potential violations of, various situations that they, and again, I can't say if it's right or wrong. I'm just saying that, the upside for non-government intervention is that it potentially spurs innovation, and it leads to job growth, and it leads to people from other countries coming to the United States and starting new tech companies, for example, and that is really a robust way to spur economic growth. On the other hand, if you don't have some sort of oversight on some of these very large unregulated companies, what's the downside to individual freedoms? What do we sacrifice? I've been attending a lot of conferences on big data, but the big data question really is on privacy, right? If big data isn't protected, your privacy may be eroded. And what happens is when there's, unprecedented, unanticipated cyber attacks, how are individual liberties protected then when our personal data, and I think it's no secret, the Fed had an attack where all of our personal data, or a lot of it anyway, was compromised. I mean, so there's no, in my mind, I'm probably more moderate in my thinking. I do believe that there is a role for government. I think it has to be sort of, again, because I'm a risk analyst, it has to be risk assessed. There's a balance, and I don't have all the answers. I just know that if going back to central banking, I do believe strongly that an independent central bank has a role, not only in the domestic economy, but the global economy. And back to the Harley situation is how much is enough, and how do you intervene? Now that the trade policy has potentially, at least what I've read, compromised the ability of Harley to sell hogs in China, what is the role of government now? Do you bail them out again? What do you do? I don't know.
Well, it's sure going to be fascinating to see how it unfolds. I don't think there is an exact answer, and which is what makes these particular times so interesting. And I sure appreciate you coming on to the show and sharing your insight. You have a lot of great experience, and you may be about as close to the Fed as I'm ever going to get. So again, I really appreciate having you on here. And I know you have a couple of books that you've written. Any place that you could refer folks that might want to find out more about what you've done, or perhaps get in touch or check out some of the books?
Oh, sure. So we didn't touch on gold and silver yet, but I'm happy to come on again and talk about any thoughts that I have in that area. I'm just reminded by an article that I just read right now from a central banking publication, which says central bank gold purchases soared to the highest level since 1971. And that they're basically talking about information from the World Gold Council. And they're talking about the central banks of Russia, Turkey, Kazakhstan, and their gold purchases, which is up apparently 74% year on year from the prior year. So, gold is certainly an interesting dynamic in and of itself. But back to the books, you could certainly type my last name in, Maurice, so Diane Maurice. I have edited 2 books on technology, one of them on operational risk, which addresses some of the considerations related to cybersecurity, for example, which is something that I really like to follow, because then that's sort of like unfettered market intervention by non-government entities. That's kind of an interesting dynamic and a twist on intervention strategies, at a very high level. But what I like about the books is not because I'm an editor, but what I like about the books is that each one of them has about 15 to 20 chapters, and it shares different perspectives from different people. And most of the people that, I would say all the people that made a contribution to the book are experts in their field. And given my background in risk management, the focus really is on risk managing these emerging risks related to technology that they're not going to go away. So again, I think they're listed on Amazon, but it's an interesting read for anybody, even if you only have like 5 minutes to read one chapter on developments in evaluating, managing, mitigating operational risk related to technology.
Yeah, it's certainly a lot of fascinating things that you dig into. I will put the link to that below so that people can go check that out and pick up a copy of those books. And also, yeah, it would be fun to dig more into gold and silver the next time, especially not looking so good for Venezuela and their gold these days.
No.
Very unfortunate story. Curious what's going on behind that. But we'll hold that off for next time. Again, I really appreciate you joining me. Great to catch up with you. And we'll look forward to doing this again soon.
Thanks so much.